the long short of it is that, obviously there was massive fiscal stimulus in 2020, 2021, huge burst of broad money around the world with a lag that started to translate into higher prices on aggregate because there was not a uptick in production of goods and services, but there was an uptick in purchasing power of basically at least currency units. And so you had a lot of people going out and buying things and not necessarily a lot available. When you add things like war, geopolitical risks, rising tensions between China and the United States, basically some of this globalization, maybe not going away, but just kind of, not growing the way it was, maybe even pulling back to a certain degree, there's generally more inflationary pressures. And so 2022 was a year of central banks trying to fight back, trying to rein in credit creation, trying to get the air out of excess asset prices, basically increasing the cost of capital so that most valuations compress, a lot of malinvestment gets kind of pushed out of the system. And right now we're kind of at an inflection point here in 2023 because fiscal policy is still very accommodative. There's still very large deficits kind of flowing into the economy, but central banks are still being kind of aggressive. And I think, one of the risks of a policy mistake is that normally higher interest rates are a way to reduce money creation from bank lending, right? So when we think of the 1970s inflation, that was because there was a demographics boom and banks were lending. They were creating more and more fractional reserve money, and so tighter monetary conditions were a way to try to rein that in. Whereas when, for example, you look back at the 1940s inflation, fewer people are familiar with that time frame. You had inflation that was just as high as the 70s, but that was not due to bank lending. That was due to fiscal spending, obviously on the war. But then that war spending would go back into the economy, and so you had a big increase in the amount of money in the system, and you got much higher overall inflation, even though banks weren't lending. And basically, we have kind of a 1940 style inflation so far this decade, but central banks are kind of treating it as though it's like a 1970s inflation. And I think this is bound to cause problems in the years ahead. I think if I were to say it overall, I think right now we're in a disinflationary period within what is at risk of being a longer term inflationary decade on average. I think we could get more waves of inflation before this decade is done. Liquidity is not the only measure that affects asset prices, but certainly in the near term. Let's say a typical equity, right? How it performs over 5 years will largely depend on its fundamentals, but how it performs quarter by quarter will largely depend on liquidity and sentiment. And the same is true for macro assets, gold, Bitcoin, certainly other cryptos as well. And so these things are going to bounce around in large part based on liquidity. And that like a combined domestic liquidity indicator is a pretty good one. And there's three main components, and so we can kind of outline what's going to happen with all three of them, right? So the Fed balance sheet is anticipated to keep going down for now. That's basically the Fed's intention to keep reducing their balance sheet, which is negative for liquidity, right? So that's kind of the background direction. Then you have the Treasury general account. That's basically the Treasury's cash account with the Fed. And this one is inverse, where when it draws down, that's actually good for liquidity. That's pushing money out into the system. Whereas when it increases, it's bad for liquidity because basically it's sucking money out of the system and then just holding it there in this void that's not actually flowing into anything. And the Treasury targets to have around $500 billion just sitting in its cash account. But one of the things that happens during debt ceiling impasse is if it goes all the way to the end, is that one of the things they do when they can't issue more debt is they can draw down their cash account to keep paying their bills until they're able to issue more debt. And so ironically, in the lead up to a debt ceiling, that could be positive for liquidity because all that cash is kind of going out into the economy and it's not being refilled. And so actually since, basically Q4, that has kind of been happening. It's been offsetting some of the Fed's quantitative tightening. So that's been pretty neutral. And then the third component is reverse repo activity, which is more esoteric, but essentially that's just another big liquidity void that's been built over the past couple of years. And that's been showing signs of flattening and rolling over. And if that does start going down, that's generally positive for liquidity as well. So the way I would describe it is that until, assuming the debt ceiling goes down to the last hour, right? So assuming it goes into the summer, assuming that the Treasury is not able to issue net new debt, we're probably going to see a TGA drawdown. And that's going to offset some of what we're seeing in the Fed's quantitative tightening. So we have kind of a neutral liquidity situation overall, most likely. I do have concerns around the second half of the year because at that point, if the TGA is drawn down and the Fed's still doing quantitative tightening, if there is some sort of debt ceiling resolution, which you'd have to have at some point, and then the Treasury starts refilling its cash account, that's sucking liquidity out of the system while the Fed is also still doing quantitative tightening. That could be a double negative whammy for liquidity, and so I wouldn't be surprised to see pain ahead. But in order to get to that point, we first have to see how long this debt ceiling impasse goes and how far that TGA cash account does draw down. So that's kind of the flexible framework I'm working with this year, but it's subject to all sorts of change on a kind of a month by month basis. So the Fed has been decelerating their rate hikes, but they're still doing quantitative tightening at their prior pace. And we have seen disinflation in a number of inflation measures. Some of them rolled over earlier than others, but now there's a broad enough rolling over that Powell has been basically a little bit more confident in his assertions around inflation heading down, while still reiterating that they want to remain tight for longer. This, I think, ties into some of the prior issues I said before, where they're kind of, he's actually cited the 1970s and Volcker a number of times, which is kind of concerning because it's more like 1940s inflation, and he's not really citing that period. It kind of, I think, shows somewhat of maybe a recency bias in that regard, basically around kind of the sources of money creation. The Fed also, when they were talking about inflation being transitory or not being too concerned about inflation prior to this all happening, I also think they were showing a misunderstanding of money creation, which is kind of concerning from the biggest central bank in the world. It's not exactly what you want to see. So my overall view is that he's getting a little bit less hawkish, but he's still reiterating that they're going to stay tighter for longer. And I think they're essentially going to try to stay somewhat tight until they break something, right? Until you have kind of like illiquidity in the treasury market, or you have outright recession. I think they're probably going to stay somewhat tight. Now that is kind of complicated because if you look out long enough, that can actually be inflationary. If you have high interest rates on very high public debt levels, and you keep running deficits anyway, that actually pours more and more money into the economy. Basically, the federal deficit is a surplus for the private sector, which sounds good unless it's money creation. It's inflationary over the long arc of time. But it does spell kind of risks, I think, kind of for the rest of this year. I do think that the market is I think I'm not betting on a soft landing. Let's put it like that. I think either you're going to get kind of an inflationary breakout or you're going to get a recession that temporarily quells inflation. And that seems to be the way that most economic indicators are pointing to by either the end of this year or early next year. Well, so yeah, my challenge is I'm in multiple corners due to the intersections that I operate in. If I look in the traditional macro area, most of them aren't really talking about crypto. A lot of them are kind of doing the thing where like, oh, it's dead, right? Kind of like how 2018, 2019, it just kind of not on their radar anymore. It's dead. Uh, same, including Bitcoin for that matter. Basically, they're just like, yep, the whole space bubble, it's gone. They view it kind of like ARC style stocks, basically unprofitable growth stocks. Um, Obviously, when I look at Bitcoin spaces or when I look at crypto spaces, which are increasingly kind of two separate spaces with some degree of overlap. Um, Basically the Bitcoin people are generally in pretty good spirits. I mean, I was at Pacific Bitcoin, for example, while FTX was happening, and so the Bitcoin price was nuking, the whole industry was nuking, and people were like celebrating and laughing about it, and just kind of just kind of rolling with it. Um, Obviously there's a lot of development happening in the space. People often talk about lack of Bitcoin development, but of course that's mostly base layer focus. There's actually quite a bit of ecosystem development, basically making Bitcoin easier, more accessible, faster, more expressive, things like that on various parts of the ecosystem. As for crypto, I mean, this week was big. I mean, the past couple weeks, there have been a number of people warning about increasing levels of banking system cutting off various crypto entities. And then we've kind of seen the hammer come down on custodial crypto staking from the SEC, basically kind of looking at that as like an investment contract that is subject to regulations. I think this has been rather telegraphed since the FTX debacle that really kind of lit a fire under regulators, gave them a lot more, uh, kind of just, coverage to go after certain things. We've also seen a shift in the head of the Commodities Futures Trading Commission. he used to kind of talk about Ethereum being a commodity like Bitcoin. He walked those back in November, those statements back, and kind of would say, okay, Bitcoin's a commodity. We'll see about everything else. We'll leave that to the SEC, which kind of, we kind of know Gary Gensler's view on that whole thing where, Bitcoin, maybe a couple other proof of work coins are kind of, commodities in his view, while everything else is at risk of being labeled a security. So I do think we're kind of seeing a shift away from some of these, kind of